and welcome to Live Wire Markets. My name is Chris Conway. Today I'm joined by three members of the Yarra Equities team, Marcus Ryan, Michael Steele and Joel Fleming. They are going to be sharing with us insights from the season and the key themes and opportunities across the entire market cap spectrum. Marcus, I'll start with you. How would you characterise reporting season?
Thanks, Chris, and great to be here. Look, overall, describe reporting season as really solid. I think what we can think about is, in aggregate, the ASX 200 is broadly flat through reporting season. And just for some context there, that takes the 12-month return for Aussie shares to about 10%. What's really interesting to us is when you actually peel through all the results, you can actually see that the level of beats has been well in excess of the number of misses. So we look at something called the beat to miss ratio, and we've actually seen beats be 9% higher than the number of profit misses. And for context, that ratio was 1% at the end of reporting season last year. The final point I'd make though, and why I'd say very solid and not excellent, is what we have seen some moderation in earnings expectations for the full fiscal year 24. We're expecting now earnings to be off about 5.5%. That's come down 1% or so. And really that's been driven by the resources sector, but we have seen strength in consumer discretionary, utilities and the REITs.
Michael, I'll come to you now. I know you focus on small caps. How have you found the season?
Overall, it was a positive reporting season for small companies, so that's on an X100 basis. Earnings expectations, excluding resources, came in line with consensus expectations, and that's a material improvement compared to the last 18 months where we've seen significant downgrades to earnings. Looking forward, which is more important, we've got confidence of an accelerating earnings growth outlook with earnings growth of 10 to 15% in the next 2 years, and that's based on those earnings coming on in line with expectations, excluding resources, and also the positive outlook statements we saw.
Joel, I'll come to you now. We want to talk some major themes. What was one of the major themes that you saw, especially in microcaps?
Look, expectations were too low, obviously, coming in. So that's our starting point. And across the board, I think that people were surprised at just the strength and resilience a lot of these companies. Been focused a lot on the macro. People have been surprised at how well the Australian economy is performing. And that flowed through in reporting season. The second point, I think, is just that active management of the cost base. So inflationary pressures are coming down, the top line's been supportive, but a lot of companies have been doing some good work on making sure those cost bases are really efficient to be able to capture as much of that margin potential as possible.
Marcus, I'll come back to you now. A major theme in large caps, what have you seen?
What's really interesting in large caps, Chris, is in fact, and maybe building off Michael's point, is that comment around margin outcomes. We've observed that in small caps. We've actually observed that for the large cap companies as well. What was really interesting, once again, when you go through all the results, is that margins beat on about 30% of cases of results. That's well in excess of margin misses. Actual fact, when you look through the ASX 200, about 3/4 of companies that reported have seen margins that are flat to higher. So that was a really key theme. The second theme that I'd really call out is, while the market was flat overall, we saw significant divergence between sectors and stocks during the month. In particular, the consumer discretionary sector up 6%, we saw utilities strong, we saw REIT strong. And on the other end of the ledger, down at 6% we saw resources, some weakness in commodity prices, and indeed some of the more defensive sectors like telecommunication and consumer staples.
Gents, I want to talk AI now. You're probably sick of talking about it or hearing about it, but I want to try and understand whether there are material impacts that are occurring on the ground. So Michael, I might come to you on this one.
AI was a big focus during reporting season, and we expect it to have a material impact in the medium to long term for companies. And there's three elements to consider. Firstly, companies that will benefit from helping to implement AI. So there's a range of companies that will benefit from increased demand for data networks, software, increasing data storage. So there's some clear direct beneficiaries. The next range of companies is much larger, and that's companies actually directly using AI to improve productivity in their business. And a notable trend during reporting season was the technology companies themselves being early adopters of AI, and there's quite a few examples of material productivity opportunities coming through for technology companies where they were directly implementing AI. The third area to be mindful of is there is potential with AI to have disruption of existing business models, in particular businesses which are more people intensive, and you could see automation.
Joel, what about you? How are you seeing AI adoption in the
Yeah, I
micro-cap
think
space?
Michael has covered that really, really well. I would point to two of the best performers in the small cap index this month were BrainChip and Appen, which I think broadly people would categorise in that AI category. So I thought that that was quite interesting. Agree with the sentiments about this as a medium and longer term play. There's lots of things in play here. The thing that I think is interesting though is the amount of microcaps talking about AI significantly increased during this period. That's what we expect from the sector, but in terms of actually relevance to the underlying earnings at this stage, I still think some way off.
Let's talk about the consumer. The consumer has been under pressure. I want to understand how you guys are seeing the consumer from the results that you've seen. Marcus, I'll come to you first. What are you seeing in the large cap space?
Leveraging some of the comments earlier, consumer discretionary, a real standout through reporting season. Sector up 6%, that's beating the market by 6%. Interestingly, this is now the second set of results where consumer discretionary has actually beaten those expectations. I think another interesting way of thinking about the consumer is when we actually pull apart the shopping mall REITs. These are the centres, the vicinities, the GPTs. And you look at the specialty sales growth that we've just seen in the most recent quarter, and they're still growing sales at low single digit, which is a really interesting data point across diverse consumer end markets. And I think to us, when we think about the consumer, there's probably two key themes that have really stood out through reporting season. The first would be that quality continues to outperform. JB Hi-Fi up in excess of 10%, Wesfarmers in excess of 10%. We're even seeing across discount department stores just that divergence between Kmart and Big W being in excess of 10% sales growth. So you're really seeing the quality retailers being able to connect better with their customers.
Michael, what about you in the small cap space?
In the small cap space, the consumer is clearly performing better than expectations, and that was evident in particular for the discretionary retailers who had stronger than expected results. Those discretionary retailers had stronger results because of stronger than expected sales, because of that demand, and also stronger than expected gross margins because they didn't have to discount to clear inventory, and they also had the benefit of lower freight costs coming through as well. So overall, the discretionary retailers had material earnings upgrades, often above 10%. There was no doubt the outlook commentary was much more positive, and listening to the result calls during reporting seasons, a clear change in tone to be much more positive from the very negative backdrop we had in calendar year 23.
Chris, if I can just add, while we did see a generally positive outlook tone, what was interesting in large cap is this idea of the trading down of the consumer. And we actually saw evidence of this across, you look at the mobile segments of Telstra and TPG results, we saw some mix shift from postpaid to prepaid. We even saw it with some of the private health insurers that are now talking about lower sales growth moving forward. Now we can debate how discretionary a private health insurance policy is. And then finally, when it comes to sort of personal lines of insurance, what we're also observing there is that consumers are actually accepting higher excesses to keep their premiums down as well.
Michael, a question for you now. What was the highlight of the season?
A highlight of reporting season for the small companies market was stronger than expected margins, and we expect margins continue to improve going forward.
Just to round out this segment, Marcus, I'll come to you. What was the low light, if you will, of reporting season?
One of the pockets of disappointment, I think we could say, is around excess inventory and destocking that still hasn't worked its way through the system for a bunch of consumer and industrial facing large cap companies. It's interesting, if we go back to last reporting season, I think there was a general sense that we would have worked through some of that destocking and excess inventory. And what we've learnt in the last month is that's not really the case. So we're seeing this around, particularly with results of Amcor and Ansell, businesses that are selling into the healthcare end market, also plastic bottles for beverages. And why it's a real area of disappointment and also reflection is it causes investors now to really ask the question, what does underlying demand look like moving forward if there is customers that still have excess inventory and their ordering patterns aren't back to normal? To round that out, I would say that's in a minority, and pleasingly, overall, we would say that most companies have worked through that excess inventory. If we look particularly at the building material companies, if we look at the retailers.
All right, gents, we're going to focus now on your respective cap spaces. Joel, I'll come to you first with micro caps. How important is it the companies that you're looking at can fund their own growth? And what did you see during the season regarding that factor?
You live and die as a small business on your funding piece, right? You're often not profitable. It's all about investing, getting investors to believe in that story, to be able to grow those revenues and turn into a business that's more important in its industry, that it's profitable, growing, more durable, and all of those good things. So that has never changed. A couple of years back, capital was widely available. Yeah. That has changed dramatically. So investors are a bit more sanguine about what they're investing at the moment. We understand microcaps have been left behind over the last couple of years, but that particular point has not changed. The flip side is this reporting season was really supportive in terms of some of these businesses hitting those inflection points, moving their models forward, and balance sheets and cash flows were pretty good. So you're always in a bad position when you need to raise capital and the environment's not great. But on the whole, we're investing in companies where tangible improvement in the business. The balance sheet's looking good, they're generating cash, and they're starting to move into that self-funding piece. That never changes how important it is. But I would say it feels like the market's opening up a little bit in terms of investors willing to look further down the market cap spectrum. And that's because it's looking a little bit better in terms of the outlook, and it's a sector that's been left significantly behind.
Joel, microcaps can be incredibly exciting. What are the most exciting trends that you're seeing?
In terms of trends, I think it's always, we spoke before about the AI piece, right? Yep. So we're hearing lots of noise about AI. Are we seeing anything that's tangible there? No, not yet, but we do know that there will be some really interesting gains made in that space. Across the board, I think some of those sectors that have been left behind in terms of resources, there's some really interesting companies there. They have deposits, they have funding, and as that pricing signal changes, that there should be some really good support there. And micros tends to be all about innovation, about companies trying to do something different, take some market share off larger companies. The world continues to evolve and change, and that aspect means that we're always going to find some really, really interesting thematics to get behind.
Michael, I'll come to you now in terms of small caps. Many have touted 2024 as the year that small caps catch up, much like Joel was just talking about micro caps catching up. What did you see in the results season to either support that thesis or run against it?
The key factor out of reporting season that gives us confidence around the outlook for small caps is an acceleration in the earnings for the market going forward. So we expect earnings to grow by 10 to 15% per annum over the next 2 years for small caps, which is a material acceleration. Looking forward, the global economy will move from being a headwind to actually becoming supportive, and we expect global economic growth to accelerate as we progress through 2024. We expect general cost inflation to continue to reduce, which will support margins. We expect labour market capacity to improve, and that'll have the benefit of increased capacity for growth because there's more labour available, and also lower rates of wage inflation as well to support earnings. You've got the benefits coming through also in the second half of the calendar year from lower interest rates, which will have a benefit to lower cost of debt and stimulate the more cyclical parts of the economy as well. So a much more positive outlook for small companies.
One of the other things that I think is really relevant for smalls and micros, which has kind of been off the radar a little bit, but just the amount of M&A that's happened, over the back end of last year and even through this reporting season, thinking about the building materials sector, there's been a number in micros. There's capital available out there, they're seeing really good value, they're feeling more confident about the outlook for these businesses, and they're taking the opportunity to try and acquire something. So that's another thematic I think that really supports the idea that micros, with smalls to go first, micros to follow, is a really positive signal in terms of some of the value on offer there.
Michael, just to round it out, talking about smalls, having seen the latest results, you've just talked about a lot of the macro factors that you think will improve. Just in terms of valuations, where do they sit versus history, and where are you seeing some opportunity?
Small companies' valuations look much more attractive now because you've had 2 years of significant underperformance. Small companies have underperformed the ASX 100 by 24% over the last 2 years, so valuations have become much more attractive. If you look at it on a PE multiple basis, small companies are only trading at a 5% premium to the top 100, and we think that premium is too small given that really strong earnings growth outlook. When you look at valuations compared to historical levels, the small companies market is trading on a PE of 16 times. That is a 12% premium to historical levels, but you're capitalising depressed earnings in that PE multiple with significant growth going forward, so that multiple collapses dramatically as we go forward. And with so much underperformance, we're seeing a lot of opportunities across all sectors, but in particular across financials, technology and industrials.
Marcus, let's talk large caps. Expensive defensives. Are they still expensive? How are you seeing that?
Yeah, when it comes to the defensives, we would say that opportunities are emerging in this part of the large cap market. However, we really do feel that a selective approach is warranted. And as we reflect on the reporting season we've actually just been through, it's interesting to see some of the larger defensive sectors have actually been underperforming. So this is healthcare, where we've seen demand profiles be a bit below expectations and sticky costs still in businesses. The supermarkets, where like-for-like sales are starting to moderate and once again sticky costs of doing business. And then also telecommunications, where we're seeing really mobile segments within Telstra and TPG struggling to grow margins at the rate that they have in the past as well. So when we think about the opportunities broadly today, within healthcare, we are overall underweight that sector, and that's really around some of the margin trajectory that we're seeing around some of the pathology groups. We're seeing even with the large cap CSL, demand slower to come back, costs still an issue. The standout for us in that space is ResMed, top 3 position in the portfolio, high quality names, trading at a significant discount to where it's been historically. When I think about then consumer staples and the supermarkets, look, we continue to avoid this space. These names are trading at in excess of 20 times earnings multiples. As mentioned, we think the earnings trajectory is increasingly challenged from the prior few years. Where we do see some opportunities in the real asset space, so to call out a couple of names there, high quality infrastructure, Transurban, attractive dividends, growing dividends, good capital management. And on the REIT side, a sector we've recently moved back into, Vicinity is an example of what we would consider a high quality shopping mall owner. You know, we're getting a 6% dividend yield, stock's trading at a 14% discount to its underlying value. So that's a bit of a flavour for how we're seeing the defensive space today.
Marcus, last one for you, the big miners. They've paid very healthy dividends over recent history. What did you see this season, and what's your outlook or expectations for those dividends and the miners moving forward?
I think if we look back into the last fiscal year, that resources space generated north of 35% of large cap dividends. So tremendously important, particularly for investors that really do value those dividends. When we reflect on the reporting season we've just been through, what we've actually observed is that for the large iron ore miners, and I'll talk about BHP and Rio here, dividends were actually a little bit ahead of expectation, a couple of percent. What was interesting though is that wasn't really driven by profit beats, but rather just nudging the payout ratios a little bit higher. So today we're presented with the large iron ore names offering in the order of 6% dividend yields, fully franked. Importantly though, when we think about the vulnerability in that dividend moving forward, we think that vulnerability does exist. What we can't ignore is about 60% of those dividends are being paid out of the cash flows from iron ore. And at the moment, the iron ore price has actually retraced over February from 130 a tonne to 120. We would see the potential for that price to continue to moderate, and as a result of that, put some pressure on the dividend. And what I haven't mentioned is those large diversified miners do have some other offsets in their businesses, but as a general comment, attractive dividends today, but we would see the potential for some vulnerability.
Gents, I'm going to throw it open now. There's a few themes that cover the entire market cap spectrum. So I'm just going to ask some questions around some of the major themes out of the season. The first one, of course, being lithium, the one that everyone wants to know about. First open question, EV demand. Has it failed to live up to expectations? And what does that mean for lithium producers?
In terms of EV demand, there's a clear long-term structural growth to that market. The global economy looking to reduce carbon emissions, that is a structural trend that will continue. So there's no doubt EVs will continue to grow over time. Your question is correct though. We have seen slower than expected growth in EVs over the last 12 months. We've seen expectations reset to much more reasonable levels. And even at these levels, the absolute levels of growth are really quite attractive, still at 20% year-on-year growth. What's interesting with what's happened with the slowdown in demand, and also you've seen the lithium price overcorrect on the downside, is it's created an opportunity to invest in some of these lithium companies because you've seen the commodity price overreact on the downside. You've now got close to 25% of the industry's producers losing money at these levels, so the spot price is overcorrected. you're going to have a major slowdown in new projects coming to market because the incentive price is significantly higher than the current spot pricing. And you've still got those longer term structural growth opportunities with reducing carbon emissions. So we think it looks really attractive now, the lithium sector, after this dramatic sell down.
From a microcap perspective, it's interesting because the whole sector moved out of our investable universe, right? You know, even someone exploring had a market cap of $250, $300 million.
Yep.
So this gives us the opportunity to revisit. The structural theme continues to exist, and it's about us going through. And there's some really interesting companies which they're in good jurisdictions, which of course is super important. They've got a resource, so there's actually something there that's been quantified. They raise money at the right time, so the balance sheet means they can see through the next couple of years. And so in terms of what we can actually invest in, that's looking far more interesting. And to Michael's point about risk and reward, you've got the cash, you've got the deposit, looks like it's in the right place, and then it's just about that execution piece going forward and waiting for the price to recover. We're actually quite excited about some of the opportunities.
From a large cap perspective and a lithium perspective, we're really presented with about 4 opportunities of companies that can give us that exposure. And I think what we've been able to do is to move into Pilbara in recent times. And what makes that a standout, and building on Michael's point, it is a producer. So we like that attribute. We like the fact that it's got a great cash position as well. It can fund its production growth. We like the fact that its asset is here in Australia, so low sovereign risk. Might sound a little bit odd, but the fact that the stock is about 20% short at the moment, we actually like the potential. The delta on that is obviously one way. And we like the management team there as well. So look, what that means is we're coming into a commodity, you know, around US 850 at the moment. You've probably got an incentive price that's around 1400. That's a good point in time, we feel, given the demand supply outlook, to consider the commodity and come into what we say is a high quality company in that space.
Very interesting insights, Marcus. We actually had one of my colleagues speak to the CEO of Pilbara recently and said a lot of the same things that you're talking about. And his message to the shorters was just be aware that prices can change pretty quickly. So some loaded comments there from the CEO, which was interesting.
Well, that's it, because you look as quickly as that short interest has come up, you can imagine how quickly it could come down.
Rallies. Yeah, absolutely. All right, gents, let's shift gears here. We're going to talk about copper, not so much loved in terms of compared to lithium. Why has it struggled for upside despite the well-documented supply challenges and the fact that there hasn't really been any new supply come online?
For context as well on copper, like we're talking about a commodity here that's trading at about $3.80 US a pound, and it's really range bound in that 350 to 4 recently. And I think one of the reasons that it hasn't really taken off as many had expected, we have seen demand over the last 12 months be a little bit softer than what some might have expected. Where some might have expected sort of more 4% plus type demand growth, we've probably seen, and we're running at about 3%. And let's keep in mind as well that demand outlook, and we would support that positive demand outlook as well, is really being underpinned by some of the energy transition. If we think about electrification, supporting that demand moving forward. So I think what we like about the commodity today is a lot of the work we've done at the commodity level is saying that there are supply constraints to bringing on new copper mines, and we would see over the next 3 years supply really running at less than 3% per annum, with the potential for demand to run higher, inventory levels low. We put that together, we see a scenario of price moving well north of $4, and as a result of that, leaves us positively disposed to copper as a commodity.
Gents, in a word, is there anywhere investors can go on the ASX to get some copper exposure in any of your respective spectrums, cap spectrums?
Yeah, so from a microcap perspective, we really like, it's very small scale, but it's got growth opportunities. AIC mines, that looks really interesting to us, but is often the way it's the picks and shovels. And so we'd look at something like Lycopodium, who's a big engineering company. They're working on some early stage engineering for some massive copper projects for Barrick. And look, there are some gates to get through before those projects are sanctioned, but they do help to address some of those supply issues. So playing it through the engineering side is another way that we're thinking about getting exposure to the thematic.
Anything to add?
Preferred copper exposure in small caps is Sandfire Resources. So Sandfire is going to benefit from that strong copper price outlook. They've also got very strong volume growth on a copper equivalent basis. Production growth is increasing by 50% over the next 2 years, with further opportunities in the medium term to increase the rate of production and also increase mine lives dramatically as well.
It's really interesting because it's an example of where we can have a view on a commodity, but the opportunity set to take advantage of that for our investors is quite different across the different market cap cohorts. So from a large cap perspective, that's the challenge. It's very hard to get now a pure play copper exposure, with BHP having taken Oz Minerals out last year. So our process is to find good copper exposure within diversified miners in large cap equities. And how we're approaching that at the moment is really we're getting that through BHP, while predominantly iron ore, circa 30% from what we would say is a high quality copper exposure. And actually Evolution Mining, which is typically a gold company, but now almost about 30% of that business is copper too. So that's the way we're playing it and trying to get exposure for our investors.
Gents, last major theme or segment that we'll talk about, financials. What's the favourite financial subsector at the moment? We've got insurance, brokers, banks, regionals. Where are you guys finding opportunity?
From a large cap perspective, and for context, financials are around 30% of the market cap. 21% banks, 5% the diversified financials, that's the Macquaries of the world, and then 4% in general insurance. And it's in that latter bucket of insurance that we see the opportunities today within the financial space. That's QBE, that's IAG, and we were really encouraged through this reporting season with those positions. What we like about these insurance companies is selling products that are largely non-discretionary in nature. You need your motor insurance policy, you need your house covered, right? And still a cost that is relatively small for the consumer to bear in the scheme of the annual wallet. Importantly, the industry structure we see is still quite supportive, and as a result of that, that's where we see the opportunities.
Marcus, just as a side note, I received my insurance premium the other day and saw it go up by 20%. I thought, thank goodness I hold some insurance. It's the only way I get a little bit of that back. Gents, have investors underestimated the strength of the major bank rally? Probably one for you, Marcus, again. And what would you do from here in terms of the big four?
Yeah, well, I think, look, it's the right question to be asking at this point. If we look at the last 12 months, banks, the major banks are up 20% against a market that's up 10%. So the banks have recovered well. They've really recovered well, we would say, as a result of two factors. Just a more positive view around the general domestic economy, what that means for potential loan losses. And also just the competitive landscape has probably reduced from peak levels last year. Sitting here today, however, our view on the banks, we would see the opportunities more so in insurance than the banks. We see a challenged outlook for pre-provision profits and, in simple terms, cost growth within the banks, continuing to erode any of the income growth.
Michael and Joel, I'll come to you now. There are some exciting things happening at the smaller end of the spectrum. We've got digital payments, we've got neobanks. How are you guys viewing that space and what are you finding attractive at the moment? Michael, I'll come to you first.
The financials segment within the small companies market is highly attractive. We've got a number of investments in this part of the market. You've got the advantage, there's a number of defensive financials in the small companies market and also a number which are rebounding from cyclical lows as well. So in terms of the defensives, you've got insurance brokers and also trustee companies where we have a positive view. They'll continue to report defensive growth there. In terms of the cyclicals, there's been a number of cyclicals that have been negatively impacted by very low rates of equity inflows into equity markets. And we're starting to see some early signs that that's recovering from depressed levels. So we can see cyclical upside in the platforms and also the fund managers. The other segment is the companies providing debt finance, and they've had a very difficult time. You've seen a dramatic change in funding markets, concerns around NIMs and bad debts. But we're starting to see some signs of improvement there from a very low base.
Joel, what about you in microcaps?
Yeah, financials are hard because it tends to be a game of scale. There's a lot of operating leverage and a lot of financial leverage. So we're looking at the situation at the moment where things did get very oversold and sometimes a new management team can come in and improve things. So the performance of Zip has been really interesting. Off a very low base, it's performed very, very strongly. To Michael's point about the losses and the fact that consumers are actually doing better, some of these lending companies are performing really well. People thought that they were out of business and they've survived and the consumer's been better. So that's been interesting. But again, I think the risk factors around that leverage, both operating and financial, makes the sector really difficult from a small base in microcaps. Where we really like generation development which is a business that has investment bonds and an annuity product. It's also a part owner in Lonsec, and they're doing some really interesting things with the changes in super should help benefit some of their products. The fact that people's families are becoming more complicated and the need to kind of structure things differently. There's some really interesting offerings, and their annuity products should benefit as interest rates come down as well. So we think that that's really interesting and sits nicely in that financial space without taking that huge amount of operating and financial leverage on.
Joel, Michael, Marcus, thank you so much for sitting down with Livewire and chatting through reporting season.
Thanks, Chris.
Thank you.